Not all dividends are built the same. Pick the wrong stream, and you could be stuck with tiny payouts that barely move the needle. But pick the right one for your goals, you unlock a steady flow of income that actually fits your life. Need cash now? Want long-term growth? Or a mix of both? In this video, we're breaking down 3 powerful dividend streams and showing you exactly which one matches your needs, your timeline, and your freedom plan. This isn't cookie-cutter advice. It's a customized path to real income, because the right dividend stream can change everything. Part 1. Setting clear purposes for each layer. Not all dividend income is created equal, and if your portfolio is just a pile of random stocks with good yields, you are missing the real power of dividend investing. Imagine your portfolio as a living system. Not a spreadsheet, not a pie chart, but something alive, evolving, adapting, and working together. That is why you need 3 distinct layers, each with its own purpose. No overlap, no confusion. First, the stability layer. This is your foundation. It is not here to impress. It is here to survive. Blue-chip giants that pay dividends like clockwork through crashes, wars, and recessions. This layer is about reliability. If it is not boring, it does not belong here. Next, the income growth layer. This is your engine. These are companies that raise their dividends year after year. They beat inflation. They build wealth over time. You are not buying these for the biggest yield today. You are buying them for the even bigger yield tomorrow. Finally, the booster layer, the wild child, the small slice of your portfolio that takes smart, calculated risks. These are the high-yield, high-upside plays, the REITs, the MLPs, the overlooked sectors. They add spice. They push your returns higher, if you control the risk. Here is the mistake people make. They mix these roles. They expect high yield from growth stocks, or they demand safety from speculative plays. That is how portfolios break down. So define your layers. Set clear roles. Make your portfolio work like a system. Because in the next part, we are going deep into the most critical layer of all. The fortress. The stability layer. Part 2. Understanding the stability layer. This is the heart of your dividend portfolio. The layer that never flinches. The stability layer. If everything else crashes, this is what stands. Because this layer is made of giants, fortress-like companies that have paid and raised dividends for decades. Let us start Johnson & Johnson. This is not just a healthcare company. It is a dividend machine. 63 years of uninterrupted dividend increases. In 2025, they did it again, boosting the quarterly dividend to $1.30 per share. That is over $5 a year per share in pure passive income. And they are not reckless about it. Their payout ratio? Just under 55%. That means they pay shareholders generously, but still hold enough back to grow. This is discipline. This is strength. Now look at Procter & Gamble. You probably have one of their products in your home right now. But did you know they have been paying dividends for 135 years? That is through 2 world wars, the Great Depression, and everything since. 69 straight years of dividend increases. In 2025, they raised it again. Over $4 per share annually. Their payout ratio is about 63%. Tight, reliable, and sustainable. These companies are not just stable. They are built to endure. This layer is not for wild gains. It is for reliability, for the kind of income you can count on when markets panic. These are your sleep-well-at-night stocks. The stability layer is your portfolio's backbone. Strong, predictable, untouchable. But what if you want more than just survival? What if you want your dividends to grow and evolve, just like you? Then you are ready for the next level. The income growth layer. Part 3. Building the income growth layer. If the stability layer is your foundation, this is your engine. The income growth layer. This is where your income does not just sit, it climbs. Slowly, steadily, year after year. These are not the highest yields today, but give it time, and they grow into monsters. Let us start with Microsoft, not just a tech titan, a dividend growth powerhouse. For 20 years straight, Microsoft has raised its dividend. 20 years of uninterrupted increases. In 2025, it is paying 3.32 per share annually. But here is the magic. The growth rate. Over the last 5 years, their dividend has climbed more than 10% annually. That means your income is doubling every 7 years, without lifting a finger. Now look at Visa. 17 straight years of dividend hikes. Their annual dividend in 2025, $2.36 per share. Yield? Modest. But the growth? Explosive. Visa's dividend has grown nearly 18% per year for the past decade. 18%. That is not just inflation-proof. That is wealth building on autopilot. These companies are not static. They are thriving. Their cash flows surge, and they reward shareholders right alongside. This layer is perfect for long-term thinkers. You are not chasing the biggest check today. You are building the biggest stream tomorrow. And every raise adds fuel to the fire. Stack a few of these in your portfolio and watch your income snowball. Slowly, predictably, powerfully. But maybe you want a little more adrenaline. Something with heat. Something that could explode. If you are willing to take the risk, because next, we are building the speculative booster layer. Part 4. Designing the speculative booster layer. This is where things get exciting. You have got your stability. You have got your growth. Now it is time to take a little risk. Strategically. Welcome to the speculative booster layer. This is not about betting the farm. This is about allocating a small slice, maybe 5 to 10% of your portfolio, for maximum upside. These are the income plays that make your pulse race. The ones with the highest yields and the highest risks. Let us start with REITs. Real estate investment trusts. They have to pay out most of their income as dividends. That makes them income monsters. Take Omega Healthcare Investors. This REIT focuses on skilled nursing facilities, and it's currently yielding an eye-popping 9%. That's right, 9%. Then there is Chimera Investment Corporation, a mortgage REIT, yielding over 11%. And PennyMac, another mortgage-focused name, at nearly 11% too. These are not for the faint of heart, but the income can be explosive. Want to go even deeper? Enter the world of MLPs, Master Limited Partnerships. These are energy infrastructure plays. Pipes, storage, logistics. Enterprise Products Partners is a favorite, yielding about 6.5%. Same for Energy Transfer, and MPLX kicks it up to around 7.5%. These companies are built to generate cash, and they pass a lot of it to you. But here is the rule. You respect the risk. These are not set-it-and-forget-it stocks. You monitor them. You trim when needed. And you keep your exposure tight. Handled right, this layer gives your portfolio the kick it needs, without blowing it up. So now you have the 3 layers: solid foundation, rising income, and turbocharged upside. But how do you put them all together? How much should you allocate to each? That is exactly what we tackle in the next part. Part 5. Allocating weight to each layer. Now you have the layers: stability, growth, boosters. But here is the million-dollar question. How much do you put into each? Get this wrong, and your whole system can wobble. Start with the stability layer. This is your foundation. If you are conservative or near retirement, this should be your heaviest allocation. Think 50% or more. Why? Because this layer is built to last. It pays you even when the market freaks out. Next up, the income growth layer. This is your engine. It pushes your income higher over time. If you are middle of the road on risk, this is where you might park 30 to 40%. Enough to outpace inflation, not so much that you lose sleep. And finally, the speculative booster layer. This is your heat, your high-octane juice. But it is also your biggest risk. For most investors, 5 to 10% is more than enough here. That is all you need to turbocharge your returns without blowing things up. Here is the trick. Your mix should match your mindset. Risk-averse? Load up on stability. Chasing long-term growth? Tilt toward income growers. Comfortable riding volatility? Add a bit more booster, but keep it measured. And this is not a set-it-and-forget-it game. Rebalance. Reassess. As markets shift and your life changes, your layers should adjust too. This is not diversification by sector. This is diversification by purpose, a system, with each part doing its job. But there is one more layer we have not talked about yet, one that blends perfectly into your foundation and boosts your yield even more. In the next part, we dive into the secret sauce, preferred stocks for income stability. Part 6, incorporating preferred stocks for income stability. What if you could boost your yield without boosting your risk? That is exactly what preferred stocks are built for. Think of them as the missing link between bonds and stocks. They pay like fixed income, but sit inside your stock portfolio, and they are perfect for strengthening your stability layer. So, what are they? Preferred stocks are a special class of shares that pay fixed dividends, often higher than what you get from blue-chip common stocks. They also come with priority. That means if a company ever gets tight on cash, preferred shareholders get paid before common shareholders. And many preferreds are cumulative. That means if the company skips a payment, they owe you back pay before they can pay anyone else. You are not left out in the cold. They are also less volatile than common stocks. So while the market whips around, preferreds often hold steady, still paying you like clockwork. And there is a tax bonus too. In many cases, those dividends are tax-advantaged compared to bond interest. More net income in your pocket. Here is where they shine. As part of your stability layer, preferred stocks can act like an income buffer. When common dividends get cut, preferreds often keep flowing. But do not get too comfortable. Preferreds can be sensitive to interest rates. When rates rise, their prices can drop. So you want to be selective. Use them wisely. And preferreds can be a powerful tool. Steady, high-yielding, and built for resilience. But what if the income looks great until it vanishes? In the next part, we will show you how to spot dividend traps before they blow up your strategy. Part 7. Avoiding dividend traps and ensuring sustainability. High yield does not always mean high reward. Sometimes it is a trap. A dividend trap. That stock promising 10% yield? It might be a ticking time bomb. Because when the dividend gets cut, your income disappears, and the stock price tanks right after it. Here is how to spot the danger before it hits. First warning sign: sky-high yield. If the dividend yield looks way too good to be true, compared to the rest of the sector, it probably is. Often, that yield is only high because the stock price has crashed. Second, a payout ratio over 100%. That means the company is paying out more in dividends than it is earning. That is not sustainable. It is bleeding cash, and sooner or later, that check will bounce. Third, negative or declining cash flow. If the business is not generating free cash, they are either borrowing or selling assets to keep paying dividends. That is financial gymnastics, and it will not last. Fourth, crushing debt. A high debt-to-equity ratio puts pressure on every dollar, and when interest payments rise, dividends are often the first to get slashed. Fifth, falling earnings. No profits, no dividends. Earnings trends tell you where the company is heading, not just where it has been. Sixth, a dying industry. Some sectors are in terminal decline. Do not anchor your income strategy to a sinking ship. You need to be a detective. Check the payout ratio. Study the cash flow. Scan the earnings reports. Do not let yield seduce you into a broken business. Remember, sustainability beats size. A smaller, growing dividend is always better than a huge one about to vanish. And now that you know how to protect your portfolio from collapse, how do you open it up to the world? In the final part, we go global. International diversification for dividend investors. Part 8. The importance of international diversification in dividend portfolios. You have built your dividend portfolio. It is layered. It is strategic. But is it global? Because if all your income comes from one country, you are exposed. Enter international diversification. This is not just about chasing foreign stocks. It is about building resilience. Different countries, different economies, different cycles. When one market stumbles, another might surge. By investing internationally, you tap into diverse economic drivers and reduce your portfolio's overall volatility. And the dividends? They are out there. Many international companies offer attractive yields, sometimes higher than their domestic counterparts. Plus, you gain exposure to sectors and industries that may be underrepresented in your home market. But be mindful of currency risks. Exchange rate fluctuations can impact your returns. Consider using hedged investment options or diversifying across multiple currencies to mitigate this risk. Also, be aware of varying tax implications. Different countries have different tax treaties and withholding rates. It is essential to understand these before investing. Incorporating international assets into your dividend portfolio is not just a growth strategy. It is a stability strategy. It is about ensuring that your income stream is not tied to the fate of a single economy. So, look beyond borders. Expand your horizons and build a dividend portfolio that is truly diversified. If you've made it this far, I've got a powerful dividend strategy guide made just for you. And it's completely free. This guide breaks down the 3 dividend streams we covered, helps you match them to your personal goals, and includes a simple worksheet to build your custom plan. All you need to do is comment "Streams" on this video. Once we hit 50 comments, I'll share the link for everyone to download. If you're starting to see how powerful dividend income can be when it matches your life, just wait until you see what happens when that income keeps flowing, even in a market crash. In the next video, I'll show you exactly how to build a recession-proof dividend portfolio that not only survives the storm, but thrives in it. Click now to learn how to protect your income, grow your cash flow, and sleep easy, no matter what the market does.